Next chapter, financial statements of sole proprietorship firms with adjustment. The financial accounts are prepared on accrual concept basis. According to this concept, expenses are incurred in the period when benefit in terms of goods and services is received and not when payment is made. The benefit of the expenses may be received even if the payment has not been made. Similarly, the benefit may not have been received even though the payment has been made. According to accrual concept of accounting, the profit or loss for an accounting year is not based on the revenues realized in cash and the expenses paid in cash during that year. There may exist some receipts and expenses in the current year which particularly relate to the previous year or to the next year. Also, there may exist incomes and expenses relating to the current year that still need to be brought into books of accounts. Such items duly adjusted, the financial accounts will not reflect the true and fair view of the state of affairs of the business. Important items of adjustment: closing stock of goods unsold at the end of an accounting period. Accounting treatment or treatment in financial final accounts. First, trading account, credit side. Trading account, it will be shown on the credit side. In balance sheet, it will be shown as a current asset on the asset side. Balance sheet, asset side. Next, outstanding expenses. These are expenses which have been incurred during the year and the business has received the benefits from the expenses, but the payment for them has not been made. These are called outstanding expenses or accrued expenses or expenses due. In order to calculate true figure of profits at the end of the year, these expenses must be brought into books. Accounting treatment in final accounts. It will be added to the particular expense in trading account or the profit and loss account. And balance sheet, liability side. Third, outstanding income or accrued income. Income earned but not received. Accounting treatment. In profit and loss account, it will be added to the particular income on the credit side. In balance sheet, it will be shown as a current asset on the asset side. Next, prepaid expenses. Prepaid expenses or expenses paid in advance or unexpired expenses. These are payments for expenses which have not yet been incurred. The benefit from these payments has not yet been received, though the payment has been made, but the benefit from this will be available only in the following year or next year. Sometimes the benefit has been received only for a part of the payment. This is called unexpired expenses. That is, only a part of the expense has been incurred. Thus, only that part of the payment will be recognized as an expense for which the benefit has been received and enjoyed. Treatment. In profit and loss account, it will be deducted from the particular expense on the debit side. In balance sheet, shown as a current asset on the asset side. Balance sheet, asset side. Next, income received in advance or unearned income. This is the receipt of revenue which has not been earned yet. Income received in advance or unearned income. This is the receipt of revenue which has not been earned yet. No goods or services have yet been delivered against this receipt. Accounting treatment. In profit and loss account, the unearned part will be deducted from the total receipt on the credit side. It will be deducted from the income, concerned income, and balance sheet, liability side. Next, depreciation. Depreciation is the reduction in value of fixed assets. Accounting treatment. In profit and loss account, it will be written on the debit side as depreciation. In balance sheet, will be deducted out of the particular fixed assets on the asset side. Next, interest on capital. It is the cost of using the capital invested in the business by the owner or proprietor or by partners. Accounting treatment. In profit and loss account, it will be debited as it is an expense of the business organization. Interest on capital is an expense, so it will be debited. And in balance sheet, it is added to the capital account on liability side. It will be added to the capital.